if people are looking to get involved in like when you go after which strategy. So it was very tactical for like 20 minutes in the middle there where he was like talking about the state of the market, interest rates, like what strategies he used to actually grow his portfolio.
Look, my tenant's paying off my mortgage for me. I'm cash flowing every single month. It's going up in value. Like, this is a fantastic investment.
I don't think I'm even like really fully up to speed. We've been investing in real estate for 4 years. It's not something that we've come across in our journey.
So it started with that one guy, $100,000. And I went out and found a guy that wanted to fix and flip. And I brought guy one and guy two together. And he funded the project for him.
I just want to talk about the red tape in terms of raising private capital. Sometimes there's smaller deals like a flip. Sometimes there's larger raises like on the syndication side, whether it's large multi or something like that.
It's getting a little bit harder to put those together because title companies don't necessarily like them. It's hard to sell, like if you're going to resell the house.
Did you have a strategy for going about finding the right sellers where you skip tracing? What was the way for you to get to the motivated sellers? That way you weren't wasting time looking for properties where this wouldn't work.
Then I had to go through the entire process of my last 10 years of history, every loan I've done, every loan package, every investor I've worked with. I had to go through it all.
Welcome back to the Weekly Juice. As always, it's your boys Ryan and Corey here with another episode for you. Today we interviewed Kevin Amolsch. He's a successful real estate investor and private money lender. He earned his degree in finance after serving 4 years in the U.S. Army after college. Then he went and spent 2 years working with Wall Street as a mortgage bond analyst before leaving that world to go full-time into real estate investing. He now owns Pine Street Financial, and then I believe it's also Pine Street Capital. So he has a lending arm and also has a portfolio of his own. He does a lot of different things within the real estate sphere. He's based out of Colorado. We had a great conversation. We talked a lot about syndications, raising private funding,
Creative financing too.
Creative financing, and then private money lending.
Yeah. Kevin was like, he's been in the game for 20 years now. And we talked to a lot of people that have been in the game for like maybe the last 5 to 10, but the longevity of what Kevin's done, coming out of the Army, he worked on Wall Street. So he's seen like that financial side, and then he fell in love with the lending side of the business. But he walked us through like subject to lease options. So some very creative strategies that if people are looking to get involved in, like when you go after which strategy. So it was very tactical for like 20 minutes in the middle there where he was like talking about the state of the market, interest rates, like what strategies he used to actually grow his portfolio, what he's doing now, what he's staying away from. He's staying away from multifamily. He's more of a single family guy. Unless you're in the value add space. So you can tell it's pretty evident when you hear Kevin talk that he's seen it all, and it kind of shined through because he's very, very detail oriented, and he gave a real kind of masterclass in the real estate space today.
Yeah, this was a great episode. I think it walks through the importance of underwriting and going through all the different ins and outs of building a team around you. So without further ado, let's bring in Kevin. Kevin, officially welcome to the show. Corey and I are so excited to have you on here. It was great chatting a little bit pre-recording. We are doing a lot of similar things and have a lot of synergy. So we're very excited to have you on, and thanks for gracing us with your presence today.
Ryan, Corey, thank you so much for having me on. I know we had a real quick, brief conversation before you hit record. I'm excited to dig in deep here.
Can't wait. So I think we should start people with the origin story just to bring it back a little bit. Tell us what you did pre-real estate, and then when the light bulb went off for you, you were like, okay, I'm ready to go. I want to go all in. How did that transition look? And take us through your story.
Yeah, man, there wasn't a lot of pre-real estate to my story. I went into the Army right out of high school. They sold me on laser tag. Like, look, I didn't want to study anymore, right? So I was done with school, but laser tag sounded fun. So I decided to join the military. I went into the Army, and while I was in, I wasn't spending much money. I've always been somewhat frugal. I got that from my father. So I had a little savings account going. It's like, where do I invest this money? And at that time, I was just looking for an investment. So I started reading books, and then I picked up that purple one that we all know so well, Rich Dad, Poor Dad. And I'm sure a lot of your guests have shared the same experience, but that really did change my life. And I started focusing in on real estate as an investment. And I bought my first house. So I was just turning 21. Got out of the Army, moved into the house, rented it out. I was house hacking before that was a term, and kept it as a rental after I moved out. And what I saw was, look, my tenant's paying off my mortgage for me. I'm cash flowing every single month. It's going up in value. Like, this is a fantastic investment. Maybe I don't want real estate as an investment. Maybe I want real estate as a career. And so I decided to do that right after that first rental property. And I was buying one or two houses a month. And here I am, 23, 24 years old. At that time, I was going to school. So there wasn't a lot of pre-real estate, man. It was high school, Army, real estate.
Wow.
Cool.
So that's crazy that you did at such a young age, which is really cool. Can you talk to us about how you were able to fund some of those deals, and then, transition us to maybe give a little sneak shot of what you're doing today so that we can work our way up there? Let us know what your portfolio looks like. Tell us about Pine Street and all the above.
Yeah, so the financing side is where I fell in love with the business, but it's pretty cool. The second property I bought, so this was going to create my first rental property, right? I lived in that first one and I moved out and kept it. So that second property, I was in the National Guard at the time. The National Guard was basically paying for all of my school. It was a pretty high percentage of it. And I was getting the GI Bill from being in the active service. So I was getting paid every single month. So I had both benefits going. I didn't need student loans. But look, I took out student loans for a couple of reasons. Well, to buy houses. But look, it's low interest rate, tax deductible debt. Why would I not take that money? So I took it and I used that as a down payment on my second property. So that's how I got into my second one. And then I quickly realized, like, I can't come up with down payments. I just don't have that. I don't have that resource to me. So I got to get creative. I got to find out how to buy properties without down payments. And we could talk more about it, but I tripped along the way for a bit there, chasing foreclosures and doing some other things. And I ended up landing on lease options. That's what really took off for me. So a lease option, and I started buying one or two houses a month. A lease option is real simple. It's just it's a way to acquire properties using the owner's debt that they already have on the property. So that's a real creative way to get in. And I fell in love with the financing side. Look, the financing side of real estate, as you guys are learning, has everything to do with how you make your offer, how you present your offer to the seller, how you structure it. All has to do with how you're going to fund the deal. So I just fell in love with that and I started focusing on that. And it was in 2006, I started raising private capital. So first, full circle to where we are today. 2008 hit. That was the crash that many people that I talked to weren't involved in. I happened to be involved in that. It was pretty terrible. But it was then that my partner and I split and I started Pine Financial Group. So that's how we got to the company that I'm operating today.
Got it. This is interesting. We talked to a lot of investors. I think you're in the 180s of investors that we've talked to, but it's not so often that we get to talk to somebody who's been doing it for 20 years, right? So that's great, and we're grateful for that opportunity. I know that you mentioned the financing side, and I know that you were you worked on Wall Street after college. I'm curious if that or how that shaped maybe your vision for real estate, just you in general. It's a very different ball game working on Wall Street, I assume. I wouldn't know, but how did that work for you? And like, what did that teach you about what you did and did not want to do with your real estate journey?
Yeah, so this was back in like 2005 maybe, and the market started getting a little bit tougher to navigate. And the thing about lease options is you can build up a huge portfolio fairly quickly, but it doesn't cash flow great. It takes time to start to cash flow, and I missed that. I missed what I was actually capable of doing. I didn't have enough cash flow to handle the market shifting as it was. So that's when I decided to go out and get a job. So I put that in the bio. Look, I do have the experience working with Wall Street firms as a bond analyst, but I shouldn't be proud of that, honestly, because it was one of those things I had to do to survive. So I went and worked, and the company was crazy. The company went public while I was working there. So not only did I get my taste of corporate America, but I got my taste of corporate America with a private company going public at the time. So I quickly realized that, gosh, I'm just a number to them. They don't care about me. And that's when I got into the raising capital. I was in 2006. I started raising private capital, and that's when I really started having success.
So let's talk about that. I think there's a lot of great things about raising private capital. I think there's also some red tape around it too. So I want to talk about all the above. Take us through, I know you're the numbers guy. Take us through the finance company that you've kind of created and you've kind of nurtured over the last couple of years. When I say couple, 10 plus. And then your private capital game, like how did you go about it? What were some of the hiccups that you had in the beginning and what made you so great about it today?
Yeah, so I'll take you way back to, so when I started working with Susan, she's the one that took me under her wing and kind of helped me in this business. So she was She had some private capital and she was loaning that out, but then she had relationships with banks and credit unions and that kind of thing. This is again before the crash, so they would actually do this stuff. But she turned over one guy. His name was John. John says, "I have $100,000 and I want to loan it out, just like Susan does. But Susan doesn't want to loan it out. She wants me to loan it out." So it started with that one guy, $100,000, and I went out and found a guy that wanted to fix and flip, and I brought guy one and guy two together, and he funded the project for him. I got my little $2,000 fee, and all I did was bring the two people together. So it's very much a broker relationship at the beginning. And then I started getting the feedback. I need smaller investment amounts. I need some liquidity. I need some diversification. So how do I fix all three of those? It was a fund. So this is after Pine Financial was started. I started the fund in 2009. So this is the first, my first mortgage fund. And I just started raising capital at $25,000 chunks, right? That was my minimum investment. And that's where a lot of people feel comfortable starting. And I just grew that from there. Now we have 4 mortgage funds. One of them is a public offering, which that's a whole nother story to get into that. But 4 funds, and we have about $140 million. And now we're starting to layer in some institutional debt also. So now banks are starting to come back into the industry. It's an industry now. It wasn't back then. I felt, honestly, I felt like I created this thing until I went to my first industry specific conference. I was like, holy cow, guys, there's like other private lenders around here. This is actually a thing. But now it's a full on industry.
For sure. So take us through, let's go back to the beginning on the private money lending, and you connected A with B, right? So
Yeah.
How can you go about that? You collected like a little $2,000 fee. Is that like a marketing fee? There's a lot of people. I just want to talk about the red tape in terms of raising private capital. Sometimes there's smaller deals like a flip. Sometimes there's larger raises like on the syndication side, whether it's large multi or something like that. Can you maybe talk about the differences and like how they've been woven into Pine Financial?
Yeah, so I want to talk about this red tape thing. You brought it up twice, and I think this is very legitimate. And I'm glad you're bringing it up. I don't get asked this very often, and I got a very humbling story to share with you. So when I was just starting, right, Pine Financial Group, this is 2008. This is Susan taught me everything, right? But what she missed was some of the red tape. And so I got a phone call from one of my competitors. And he says, Kevin, like, how'd you do on your securities test? Man, that test was hard. And I was like, what securities test are you talking about? He's like, well, you need to be licensed to do this loan brokering thing in Colorado. So how did you do on your test? And I was like, pretty good. Hung up the phone. So here was my next call, guys. And this was a big mistake. So my next call was to the state of Colorado regulatory agency. And I called them up and I said, look, I was just told I'm violating rules here. Here's the business. Here's how I'm operating. Am I doing this appropriately? See, my mistake was calling the state and not the attorney, because the attorney would be on my side, right? Do you think the regulator is on my side?
No, absolutely no shot.
No. So here I am thinking I'm doing the right thing, and I got an invitation. I got an invitation into the office. So I went into the office, and there's this giant boardroom table. Have you guys ever seen that show, The Apprentice, when it was out?
Oh yeah,
the Donald Trump show.
You're
you know
fired.
That big board?
Yep.
Yeah, exactly. So that's the room I was in, you guys, and it was like this huge table, and I'm sitting there all by myself, and then Cheryl comes in, and Cheryl was the examiner, and she sits down, and she's not saying a word to me. It was like freaking silent. And then the big guy comes in. He had to have played football. He was like 6 something, 300 pounds, like muscle, right? Comes in with his freaking gun on his belt and his badge. He sets his badge down and says, I'm investigator, or whatever his name was. And just want to let you know, Kevin, you're under investigation. It's like, oh, that changes your day. So then I had to go through the entire process of my last 10 years of history, every loan I've done, every loan package, every investor I've worked with. I had to go through it all because I was operating without my securities license. The good news is I passed my test, and it actually wasn't that hard. So I passed the test, got my bond, and they approved me. And Cheryl actually said, you're actually doing more than what we would require to have your license. So we're happy to give it to you. So it all turned out great. But that's my first couple of months in the business as Pine Financial Group.
I think it's important to talk about
code enforcement officers, townships, state legislation, like those are people that are typically not on your side. So I'm glad you brought that up. Anytime I get a call from any of them, which is not that often, but like we're dealing with, permitting, and it's just like those things are just a nightmare sometimes. So
sure.
Glad that you found out.
Yeah. Well, I want to talk about that. So when you went through the process and, they were going on investigations, did they say, hey, you either have to get your license or you're going to have to change suit? Because the reason I asked this, because there's regulation 506B and 506C that you don't have to be a licensed broker to put these deals together. What were you doing? What were you not doing? And then was it that day forward? They're like, okay, here you go. We're not going to press any charges or whatever it's called
from the past.
The past. You just have to move forward and take the test. How'd that work?
Yeah, they gave me a ton of grace. Look, it's such a rare license. When I got mine, I was like the second or maybe third person to have one. So it's just so rare. It's called a mortgage broker dealer. So it's a broker dealer securities license, but it's for mortgages. Now, when you start talking about pooling money, like I started that first fund, now we're starting to get into the Reg Ds, right? Those are private offerings. So that's what you're talking about when you say 506. All that is an exemption from licensing. So you're exempt from licensing because of these reasons, right? So that's the Reg Ds. I don't know if that was answering your question, but it's definitely because I was brokering money between people and charging a fee to do it.
That's what I thought. Okay. That's why I asked about the marketing fee, because I've heard about this and I've had kind of like conflicting answers, right? Some people are like, oh yeah, you can do it, no problem. You just have to charge a marketing fee or something like that. Others are like, no, it's a big no. You can't broker it unless you're a licensed broker. So I'm glad you cleared it up, because I think rather than people going down the rabbit hole thinking they can do something, it's important to bring to light. So
I would definitely call an attorney, not the regulator, call an attorney and see what they say, because each state's a little different.
That is true.
Cool. So I know that you do a lot of the creative financing. We started to get into that, right? Where you're using the seller's debt. Maybe can you explain the strategy that you've used to grow your portfolio, not the traditional route, and maybe why you took a liking to that the way that you did?
Yeah, I love lease options, you guys. And for anybody that's just wanting to get started and doesn't have a lot of cash, this is a fantastic way to go. Especially right now, because interest rates are high. And there's a lot of debt locked in at 3-ish%. I think there's some crazy statistic, like over 90% of the loans, the fixed rate loans, are between 3 and 4% or something like that, or under 4. There's some crazy statistic out there.
And so people are not selling that. That's the thing. Why? And for good reason. Like what? I have a bunch of properties, not a bunch. I have a few properties, including my primary residence. That's 3.1%. You couldn't get me to sell this property. I mean, I'd borrow against it, but I'm not going to sell this. And I already have borrowed against it, but I'm going to keep it as a rental. So anyway, that's the thing. Yeah. It's like getting people to sell is a difficult thing.
Well, and let's pretend on your primary home that you got yourself into some financial trouble. Maybe it's a divorce or a job transfer or an injury or health, something that is creating some financial pressure for you, and you have this great interest rate, but you have to sell the house. You just can't afford it, even though it's a great rate. So if you could paint that picture, and then an investor's going to come and say, hey, I could pay you more than your house is worth, or I could pay you more than any of the other investors because you have this fantastic debt in place. I mean, there's got to be some motivation here, right? You've got to have that financial pressure. But what if someone could come in and make you an offer far higher than anybody else can pay because of that debt that's in place? Would that be interesting to you? And my guess is that's probably is. So the lease option is a great way to go, because it's so easy to explain. It's so easy to understand. It's literally 2 agreements in one. You have a lease, which we all understand that. I don't think I need to explain what a lease is. And then you have an option, which is just the same thing as like a stock option, for example. So you're locking in a price on the property for a set amount of time. So if you combine those two, say, okay, seller, what if I could promise you payments of X, which will cover all your financial stress for a period of time, and then within that period, I'll buy the house out for you for 100% of its value today. Is that something we should talk about? I mean, maybe you hate that idea. I have no idea. And so that's a way to get them like, oh, maybe I got my financial pressure taken off now, and I'm going to get some money down the road, right? So it's an easy way to explain to a seller. It's getting a little bit harder to put those together because title companies don't necessarily like them. It's hard to sell. Like if you're going to resell the house, it's hard to sell a house you don't own, right? You can't really do that. So now you got to figure out how to get on title and then sell it. So that's what's making it more challenging. But so the lease option is a fantastic way to start. And then I got into more like wraparound mortgages and subject to transactions. Those are a little bit harder to negotiate and sell. But once you get some comfort and some confidence, There's some great opportunities out there.
Yeah. Subject to is a hot topic, right? Anybody that listens to like Pace Morby, that's like his thing. But I'm curious. I actually would love to hear the full explanation of how, in your eyes, I mean, maybe it's not in your eyes, it's just the way that subject to works. I don't think I'm even like really fully up to speed. We've been investing in real estate for 4 years. It's not something that we've come across in our journey. Like, how would you explain that to somebody? What's the difference between that and the lease option? And then how did you go about using that to try to grow your portfolio?
Yeah. So depending on who the audience is how I would explain it. So one of the biggest things I've learned is you can't use scary words and jargon when you're talking to a seller, right? So I would never tell a seller, hey, lease option, or I would never use the word lease option, or I would never use the word subject to. That's just confusing and it's intimidating and all those things. So I would say if I was talking to you or another sophisticated investor, look, a subject to is just taking over payments. So there's a deed. There's 3 documents when you have a property with a loan on it. You have your note, you have your security instrument, which is a deed of trust or a mortgage, one of the two, depending on the state. And then you have your deed to the property. So some people get a deed of trust and a deed confused, and that's where they get tripped up on a subject to. Totally different, right? A deed of trust is security for the loan. A deed is ownership of the house. Well, because they're 3 separate documents, you could sign over that deed and not mess with the other 2 documents, not mess with the loan at all. Right? All I'm doing is signing a deed. Hey, you get the house. We see this all the time in divorce situations, right? Like one spouse will deed to the other, but they don't pay off the loan. So it's really that simple. I'm just going to buy the house from you, and I'm going to take the payments over. So that's how I would explain it.
Yeah. So Kevin, so it's another way it works a lot of times in maybe not necessarily financial trouble, but it could be somebody needs to get out of something quickly. They got to move. There needs to be a transition, but probably a financial issue, right? Where they're like, look, the house is in bad shape. I know there's all these repairs. I'm back on taxes. I can't do this. I can't do that. Can you just take this off my hands? Like, I just don't want to deal with it anymore. So that seems like the best approach. And did you have a strategy for going about finding the right sellers where you skip tracing? What was the way for you to get to the motivated sellers? That way you weren't wasting time looking for properties where this wouldn't work.
Yeah, so the lease options, the way that I found those, because they don't necessarily need to be quite as motivated. They don't need to be behind on payments or anything like that, because look, I'm not taking title to the property. They can get rid of me if they need to. All right, so those are you don't need quite as much motivation. So for those, the best way to find those for me was stale listings. A stale listing is a listing that's been in the MLS or on the market for a set period of time, but it's not quite expired. So let's say if we're in a normal market and agents are signing 6-month listing agreements, then maybe I'm going to start looking at listings that are 3.5 to 4 months old. And the reason I like that is because there's probably no equity in the property if it's sitting on the market that long. Otherwise, they'd be bringing the price down. And that's what I'm looking for. Pretty homes with no equity. So there's no equity and there's nobody else marketing to them, because as a licensed agent, you can't market to get a listing or get a sale of a property when it's listed by somebody else. I don't have a license. I'm not sure, but it's frowned on, right? They don't like that. So you have to wait for it to expire and then you can market to them. So as soon as that listing expires, you guys, they get flooded with direct mail from realtors trying to pick up a listing. So I want to hit them about 2 months before any agent is hitting them. So that way I'm the only piece of mail they're reading, and the message isn't, hey, I want to list your house. I know it's not selling. I could do a better job. No, you can't. You're gonna do the same thing everybody else is doing, right? So what they want to hear is, I have a solution. Like, I'm gonna buy your house. I don't need to list it. And so that's the message. That's how I would find the lease options. The subject twos are a bit more tricky because, look, you have to have a lot of motivation if you're going to deed someone your house and not require them to pay off the loan. Because if they default on that loan, that's your credit, right? You're going to have the foreclosure on your record, not them. They're not taking responsibility for that loan. So it has to be a significant amount of motivation. So for those, I like pre-foreclosures. Foreclosures really have 3 stages. You have your pre-foreclosure, which is everything from the default up until the sale. Then you have your auction, and that's foreclosure. And then you have your post foreclosure, which is all your REOs. So once the bank takes the property back and they list it as bank owned, that would be a post foreclosure, right? So those are your 3 buying stages. And so we focus on the pre-foreclosure stage. Now, how do you find those? Well, once they become public record, it's easy, right? That NED is filed and everybody knows about it. But can you find those before that NED is filed? So again, I'm trying to be the only piece of mail or the only person that they're talking to. So the way you do that is the best way to do that for me has been bandit signs. You guys heard of those?
Oh yeah.
Oh yeah.
They still work.
See them all the time.
That's great.
next to the missing next to the missing cat signs. Yeah.
I know it sounds terrible, and I've got crazy stories about these signs, but that's how I found the subject twos, because my messaging on there is I could pay 95% of the value of your home. This is what they need. Takeover payments. I might put takeover payments, something like that, on my sign, and I would get these phone calls. So that's how I would do the subject twos.
Let's get your craziest bandit story sign, because you teased.
Okay, so there's this intersection. There was this intersection. It was like, let's see if I could picture this for you. So it's a normal intersection, right? Across, and then you had like frontage roads on either side going this way, and then you had another road like coming through at some diagonal. So I can't count it. It's like 12 different stops or something. It's huge. It's a huge intersection in Commerce City in Colorado, out by the Walmart. If anybody's listening from Colorado, you probably know the intersection I'm talking about. So I get out of the car, and by this time I felt so brave, you guys. I've been hanging hundreds and hundreds of signs. So I used to go out at night and like wear all black, and run and do it real quick and get back in the car. But I was like, dude, F it. I'm just gonna do this. So I got out and I just started hanging my signs, going around in the middle of the day. Well, there happened to be a cop stopped at one of the lights,
roads.
one of the 12 lights, right? Of course, chances are there's. So I get pulled over, and he makes me walk around, put my tail between my legs, take all the signs down. Luckily, there was no fine. I didn't get any trouble. He just said, like, basically stop doing it again. But it was terrifying because it was in the middle of like everyone sitting there watching me, getting scolded by this cop.
There's a theme here, Kevin, that I'm learning about you as we get to know you a little bit more in this, 30 minutes we've been talking, is that you seem like you're a do it now and ask for forgiveness later type of guy, right? But I think that is what makes successful entrepreneurs really successful, because it doesn't seem like you're afraid to fail. Maybe you don't even know you're about to fail. Like you just go and do you feel like that mindset has helped you along your journey, or is it something that's just like osmosis and you didn't even realize that that's how you were?
Yeah, no, I definitely, it's very conscious. Ready, fire, aim, right? I really believe that the action piece is the piece that investors are missing. The people that want success that aren't reaching it, the piece that's missing is that action. And it's definitely overcoming fear. I mean, the fear is what's preventing the action. So for me, it's just like, I'm just going to freaking do it. And I know going in, I'm going to fail. Everybody, we are going to fail. That's how we learn, right? So I just go in knowing like, I'm going to fail. I'm going to miss. Why don't I just miss now, miss fast, so I could have success later? Now that I've backed way off as I've started managing other people's money, and now my deals, now I'm very much more conservative. But in the beginning, yeah, I guess I would call me a cowboy or something. I don't know.
Well, I think that, and Rye probably has something to say about this too, but I think that that's important. You don't look like an elderly guy, but you're older than us, right? Like we're in our early 30s. You've been doing this longer. I think that when you're our age, the mistakes they're like, you should make them, you're going to make them. And the risk reward is not as, you don't have as much of
perfect
low of a floor, right? Because, and maybe a little bit different. Like Rye just started a family. I'm not at that point. So he's taking care of other people in his life. I'm not, but when you're in your 20s and your early 30s, like those are the times it feels like to go out and like, you can get bumped and bruised and like you can pick yourself back up. You're not dealing with, institutional capital, or now we're starting to raise money for other people. So like we've entered in this echelon of like, when we do things, we want to make sure every T is crossed and I's dotted and all of that.
Yeah.
But I think when you first start, it's like, you just got to go out there and kind of make it happen. And with the expectation, Kevin, like you said, that shit's just not going to go your way, and it's okay. So anyway, that's,
I think the game,
tale as old as time.
Yeah. I think the game is just, one important class I think more people probably should have paid attention to in college is risk management. Cause I think that's all this really is. And it's kind of, is the juice worth the squeeze sometimes, and not to be on brand there, but, there's some things are it's an age game, but then like, as Corey mentioned, like as you get older, you have more responsibilities. And then as like you grow in this game, you're responsible for more things. Like in the beginning, we could take our shot on XYZ because it was our money, right? But then when you get bringing partners in and you're taking down things together, you're like, okay, you got to think about other people, other people's families and all that too. And that's where it gets a little, you want to be able to go to sleep at night, right? Like no one knows it's investing, right? You don't know if it's going to go great. You don't know if it's going wrong. I think you talked about this on another episode. Like the biggest thing and people are afraid about is fraud, right? Like every investment isn't going to go right. So if you got to know, like, and trust the people you go into business with and vet the deals the best you can. But there's market fluctuations. There's just so many things that can impact a deal these days that I think that's what prevents people from starting. And it's hard. You can do a ton of research and there you could be the biggest proponent of underwriting. You could be the most amazing underwriter, but if you don't take action, you're never going to know if you're going to be successful or not. I don't know. I'm probably going in circle here, but I'm basically talking about, we find a lot of people that are way more intelligent than us that could probably go out and do this 30 times over and they just never start.
I met somebody recently, to go off that, in a mastermind that we're in. We're in a couple. We just recently left one and entered into another one, but I met somebody and I had a one-on-one call with this person, and this person was an engineer by trade. So I got a sense of like how their brain works.
Yeah,
and they have been analyzing deals for 4.5 years. Yeah. So it was not me talking down to anybody by any means. I would never do that. But I said, so how many, like, where'd you start? How many have you done? And he's like, well, I'm about to jump in. And I was like, damn, man, you missed the last 5 years of this appreciation of just getting your bumps and bruises. And like, you're going to make that mistake, but you haven't even jumped in to make it yet. So the fear of making the mistake let this really, really smart, high level individual that was afraid to take the action, and like they lost out on a lot. Not that they could start now, right? But it kind of seems like there's a trend that they might not. So the action, like you said, Kevin, it really is the whole game, and then you learn along the way.
I love it, guys. I agree with both of you like so much. And the engineer brain, you're going to see that in real estate a lot, because it attracts that. We're talking about numbers and we're talking about analyzing transactions. So it attracts that. And you're right. For some reason, they have a hard time actually taking action. They just want to be very, very safe and very careful. So if I'm talking to the engineer listening right now and say, gosh, you just got to do it. I know it's hard. I know it's scary. But yeah, you got to do it. And Ryan, to your point, once you start bringing in other people's money, I mean, I got to believe you guys are going to be very careful with that, right? I mean, you're more careful with other people's money than you are your own.
100%. I think that's what I was leading to in the conversation, is like, Corey and I have taken risks on our own, right? As we came up into this game, and it was us talking to each other and vetting it out and going from there. But now when you bring other people into your deals with you, when you're taking down larger deals, right? You need to pool capital together to take down something. You're like, am I going to call a family member and have them come into this deal with me unless I know it's perfect? It's got to be damn near perfect for I'm not making that phone call. You know what I mean? So I think, and that's for us to be able to go to sleep at night. It is a burden, right? You're like, to scale this thing, you take it down as a group, but it's not just you anymore. And that's the thing. And with great power comes great responsibility, I guess. I don't know, hit you with a Spider-Man quote there, but it totally works. Yeah. So it's funny. It's just like, we're learning things as we grow in this game and talking to you. You've done this for 20 plus years. So maybe take us through the journey a little bit more on like, hey, when you first started pooling people's capital and getting in, like, how did you go about mitigating risk, underwriting deals? And like, how did you put your team together just so that way you knew there's more likelihood of success than failure?
Yeah, that's a good question. And the underwriting the deals has been pretty simple for me until like maybe the last 4 years. I started getting into more commercial stuff, and that's tricky. So a lot of times I'll call for help. Like, I have a network like you guys do, so I'll call and say, I don't quite understand this, and I'll get help with some of that stuff. But it's just a lot of commercials, just reading, right? You got to read the environmental report. You got to read the feasibility studies. You got to read the soil. You got to read the stuff. When I was going back, as you asked me to do, when I first started pulling money, it was all residential fix and flips. So it's not that hard to underwrite, right? Valuations are based on comparables, and we were getting appraisals. So coming up with the valuation on the properties wasn't that difficult. Now, we might mark them down from the appraisal because we knew we were in a sketchy environment, but that's really where the underwriting starts. Then we look at the borrower. We really do believe that we need our borrowers to be successful for us to be successful. So I'm going to do everything I possibly can to help them be successful. And a big chunk of that is, look, I know you're going to go over your budget. We all do. Like 100% of us go over our budget. So this budget's great and you're going to go over. So what are you going to do when that happens? So let's look at your contingency. Let's look at your liquidity. Let's just make sure that we're going into this safe. So we just built guidelines just like any other lender would do, built guidelines to make sure we're making safe loans. And we've had a great track record. I started this before the crash, so I went right through the crash with a portfolio of loans, right? And I didn't take any losses. So we're looking at about a 1.7% default rate, super low. Industry standards is between 3 and 4. So we're well below the industry standards. And I could probably count on one hand how many losses we've taken. And it does happen, but almost 2,500 deals now, and maybe 5-6 losses, something like that.
Yeah, that's amazing. That's a really good, and you're beating the standard by a good clip. So I wanted to get your take on this. We talked about this briefly earlier on. Actually, I think it might have been pre-recording when we were getting to know each other a little bit, but can you talk about your thoughts on the market and how this is going to impact multifamily and syndications, funds, like just in that ballpark? I know you were woven into the financial world, and take us through. The reason I'm asking this is because a lot of we're feeling this now too, and we all are. Like everyone's just squeezing a little bit tighter onto their cash these days. We've seen the dip in the stock market. I feel like we've had every couple of years you have these conversations, but it seems like doomsday is every year. But the reason I bring this up is you've been in the game for a while on this, and I'm wondering if you see something a little bit different now than previous, and if there's any merit to it, and just take us through the state of the market in your eyes.
Yeah, I'm glad that you asked that because we talked about that report a little bit. But look, I think multifamily is in trouble, and that's why I challenged you at the very beginning. Like, how's it going for you? Because I'm curious when I talk to syndicators, like, how is it really going? Like, truthfully, because it's not easy right now, and multifamily is a bit exposed. And the reason I say that is outside of office, it has the most loans coming due of any asset type in the next 2 years. We're talking billions of dollars in loan maturities in the next 2 years in multifamily. And look, they don't underwrite anymore. They do not pencil. And the reason for that is because of the lending standards. So in commercial, if you're not familiar, the biggest qualifier for loans is the cash flow from the property, not the global cash flow with the sponsor, right? It's how well does the property perform? And it's called a debt service coverage ratio, DSCR. So we want to see 1.2 to 1.25. Typically, that's what the banks are looking for on commercial assets. And that was working at a 3% rate or a 4% rate. Right? You could do that if you go out and get Fannie Mae money and you can get Fannie Mae on multifamily. That's the only commercial asset class you could still do that. But let's say you're getting a 4% rate. Well, you can maybe DSCR 1.2 or 1.25 at 4%. But what now when you're at 7 or 8%? What is that debt service coverage ratio? It's probably like 0.7, right? And to be clear, the debt service coverage, if I say a 1 DSCR, that means of the net income from the property, that's after all expenses, you have enough to pay your monthly mortgage payment, right? That's a 1. So if you have a 1.2, that means you have enough to pay your mortgage plus another 20%. So if you're below a 1, that means that asset is not producing enough to make that payment. And that's what we're going to see. So the question is, what are banks going to do with all of these toxic assets when they're coming to maturity and they can't get them refinanced? That's what I don't know. I don't know the answer. I don't know how that's going to work. My guess is they're going to try as hard as they can to work with the sponsors, but some of these are going to have to slip through, and they're going to go on the bank's books, and so we're going to see some inventory starting to hit the market. Combine that with higher vacancy rates because of all the new stock, the new product that's coming in. And so we're going to have an oversupply. So I just think that there's a little bit of risk here in the multifamily. I didn't even mention, I could just keep going, but what I didn't mention is there's been so many investors getting into the multifamily. It's attractive, right? So there's all these gurus out there. It's like, come to my seminar. Let me teach you how to make money. This is the asset type that you want to do it in because more doors under one roof, it's safer, right? And everyone needs a place to live. And all the things that we hear that we think that makes sense. And then it's putting us into multifamily. What does that do? It drives down cap rates. So now you're trading in 4 and a 5 cap rates and you're borrowing at 7. So that's called negative leverage. And those numbers don't work, you guys. You're going to have to see cap rates go up to keep up with the inflated interest rates. And higher cap rates means values come down. So I don't know about you, but I'd rather be on this side right now waiting for that to happen, which I believe will, than be in assets right now.
Yeah, it's interesting. Yeah, we've been very how do I say this?
Particular?
Particular, yes. Yeah. I was going to say specific. Particular about the assets that we choose, locations, type, size, right? Like there's just a lot. There's so many factors, like you're not going to win them all, but you try to get it and play to the market conditions. The scariest thing, I agree, in Europe and what you brought up there is how long are interest rates going to stay where the way they are? There's a lot of people that were waiting or banking on that refi to get the cash back. That's how a lot of these things are pitched. And we've invested in them as well, right? We have
me too.
A clip of money out. And so you're like, we were expecting a refi at the end of this year on 2 different properties and rates are crazy. And we're just like, we got to hold. And there's nothing you can do. That's the risk of the investing, right? Like similar to the stock market, you have your money in. How long are you going to keep it in there? You're going to keep letting it ride. You're going to pull it out. So they're synonymous in certain ways, but if the hard part is like, you need to know this up front. You're not always going to be there could be a 5 to 7 year window that you might have your money held until you get that refi, or you might have to sell it. You might not refi ever just based on rates. So it is a little bit of the unknown. You do your best to underwrite it properly and kind of got to vet the deal from the sponsor side, but also from the LP side. And we've done both. So we're playing the game, man. It's hard. It's definitely not easy. It's definitely a larger game than the resis that we're used to and are accustomed to. I'd like to pad our portfolio a little bit more with some more residentials. And I think we're going to see.
You mean single family?
Single, sorry. Yeah, single family.
Yeah.
But I don't know. What's your take on that? I think your portfolio is an 80-20 split. You're mostly resi.
Yeah, so there's 2 sides to this. So I have my own personal portfolio. So I try to pull money out of Pine when I can. Any good business owner should do that, right? You want to pull money out of the company that's producing income and invest it somewhere. I just choose to invest in real estate, right? Because that's where I feel the most comfort. So there's 2 sides, my own personal portfolio and then Pine Financial. So for Pine, the portfolio, yes, 80-20. I want to be heavily into the single family business because I think it's somewhat insulated from what's going on. Look, we don't know what's going to happen, right? But when you have a significant shortage in stock or inventory, that creates a floor for value. So it can only drop so far before people start buying it because there's just not enough to choose from. Combine that with the interest rate lock-in effect. So when rates start coming down, then people will start wanting to move again, and you'll see more houses hit the market. But and the interesting thing about that is when more houses hit the market because the interest rates decline, there'll be more demand also, right? So it's going to be kind of a wash there. But I think that there's some stability in the housing market. I don't think that is the case in apartments or office, but I'm not trying to be total downer here. There's opportunities all the time. I would still buy today, right now, if I could find some. I just don't think I would buy a turnkey property at a 5 cap. Right, I might buy a value add, something that's 50% vacant or 60% or whatever, that I could add value to it. Now I'm feeling a lot safer, right? Because I'm bringing the value of it up.
Yeah, totally.
That's what you want to be in. You definitely want to be in value add. I just think the turnkey stuff's too risky.
Totally. And that was the next question I was going to ask you, is that what we're seeing is that it's so, I feel like a lot of people talk about the market as a singular object or a singular like wholesale, where in reality there's so many submarkets and so many different things going on, and within if you're calling it the United States, right, there's just so many different areas of migration patterns and vacancy rates. And it's, for us, we're working with operators who are solely focused on their specific market and not buying in 27 markets across the country, because we know that they're not going to buy that deal if it doesn't pencil out the way they've bought deals based on the current market conditions. So I think that's really interesting what you just brought up, and it makes a lot of sense. And like you said, we're being very particular about what we get into. And the key is that it may not work out. So people that you're investing with have to understand that it may not work out. Now, so far, so good. Like, we want our track record to be as close to 100, like you said, as it can possibly be. But the point is that to have the humility to know, like, you are investing at the end of the day. Like, there could be a World War III. I mean, whatever, I mean, that's like, it sounds crazy. Right. But my point is that something crazy could happen. I think that the more underwriting that you can do, and the more members of your team that you can put together that have seen it and done it, is probably the way to go. So cool.
So take us through your team a little bit. Cause I know you have, Pine Financial, but like, take us through the intricacies of what you have offers out there for people, right? You mentioned a couple funds, but you're also lending. So if some
Yeah.
people came to your website, your doorstep, how could you serve them, and what are the different, I guess, lanes you have?
Yeah. So you want me to talk about the products or the team? I guess I talk
Both.
about both. But
Yeah, let's start team
so
probably.
the start team. So we have 13. We're pretty small, lean and mean, as what we like to say, right? So
great.
as we talked about, I'm very frugal. I grew up that way, so we have really strong ratios. So I don't need a big team. I don't need a big staff. I don't need a big overhead. So there's 13 of us plus 2 VAs. So I guess 15 if you count those. And the VA thing is kind of fun. I haven't really explored that all that much. I'm just now getting into it, but they're like participating in our team calls and our town hall meetings, and they're like so happy to be part of the team. It's not like just some thing behind a curtain. Like they have a name, and they want to be involved, and they want to help, and they want to see the success. So that's really cool to see. So I guess if you count those, it's 15 of us.
Sounds like you got some good VAs, because they're hard. VAs are hard.
Yeah.
Good VAs are hard to find. So congrats.
Let me ask you this before while we're on the topic, there's a couple, not Upwork, onlinejobs.ph is one that everyone seems to be using these days. Do you have any references that you've used?
So it's interesting you ask that, because I have no idea, man. I like my team. He's like right next door here. I could even run in there and ask him, but he found him because he used to work at IBM, and he ran that team that outsourced everything.
Oh, cool.
So he knew someone that manages VAs. So we manage this person, and then they bring in the VAs for us. So putting that extra person in the middle there seems to help.
Yeah, that's huge. That's great.
One of them.
You got it covered, so that's great. We'll ask you offline. We'll try to figure it out.
Yeah, I'll help you out. We had one of the VAs guys that called us and asked, like, they wanted a loan. They wanted to borrow money from us to pay like a car payment or something. And it's like, oh no, I don't think this is a VA that we want. So it's like, no, you need to ask the boss lady, right? You need to ask her, and then she'll communicate with us. So that made that conversation way easier.
Nice.
Cool. So, like Rye said, showing up to your page, what kind of offerings do you have, Kevin? Like, now that you kind of explained the team, what's the best way? Like, if people want to work with you, how do you service them?
Yeah, so we have two sides of the business. We have the private lending side, or the private investor side. So, look, we're talking a lot today about being a sponsor or investing in a syndication, and all of this is the equity investment, right? You're owning a piece of the property. So everything we do is debt. So I like that. I don't have the big upside like you guys have, right? I don't have that, but what I do have is security. Like that's why we have such a great track record, is because we're willing to take less of the deal for, to make sure we're a senior position lien holder, a debt holder, because that's the safest position in the deal to be. So that's why we like the debt side. So we help passive investors that are looking for a steady, secure return. So we're not going to see the 20, 30% returns like if you hit a home run on a value add syndication deal. But if you're looking for something that's just going to, every single month, it's just going to hit and you can count on it, that's the investor we're looking for. On the other side, it's pencils in for us. Everybody else is pencils down. We're private lenders, so we're loving this. The banks are not doing any deals, and so we're getting all kinds of leads coming in. And we get to help a lot of investors fund their projects. So we do some commercial, all value add. We won't look at any turnkey stuff. So if you're not adding value, then we're not going to be involved. And on the residential side, a lot of fix and flip and infill new construction. Cool. I guess let me dig in a little bit here, because we're geographically limited on the residential side. So we're Colorado, Minnesota, Wisconsin, and DC. There's a story about each one of those and why we moved into those. So I know it's a little scattered, but those are the 4 markets. Again, Colorado, Wisconsin, Minnesota, and DC. On the commercial side, we're nationwide, but we're a bit more conservative on the sponsor and the deal itself, because I do think that it's a bit vulnerable right now.
So take us through I'm intrigued on the first arm that you mentioned, on the passive side. So you're basically saying, like, can people come in they give you X amount of cash and you provide them with a return based on what? Can you walk us through that?
Yeah, so it's real simple. It's a public offering. So this is one of those. So at Reg D, we mentioned that briefly, but that's private. So you have to go to your private network unless you are advertising specifically to accredited investors, and then there's some rules around that. For us, we have a Reg A, which is a public offering. We could literally get listed on a stock exchange if we wanted to. It'd be a small stock exchange, but we could we could go that route. So we could put up a billboard and say, hey, we'll pay you 8%, invest with us, minimum 10 grand or whatever the terms are, right? So our minimum right now is 10 grand, we pay 8%. So I could put that up on a billboard and I could accept non-accredited investors. But the downside to that for us anyways is the administrative. So we have lots of reporting to the government, audited financials. We have, twice a year, full reports to the government. So all of that is tricky and hard to navigate, which is why we have a great legal team and it's expensive, right? So it's really simple. 8% pays out every single month. You can reinvest it. You can take the money out. There's no lock-in periods, no fees. All of our money is made between the spread, what we loan it for, and that 8%, and the fees we charge our borrower. So it's not a home run again, but it's a nice little steady investment to add to a portfolio for some stability.
So I assume it's taxed the same way. So for example, let's say we gave you 100 grand and you 8% of that, what, $8,000? So $8,000 that gets paid monthly out. Is it just divided by 12 and then you guys pay it, you slowly drip it out? Is that how it is?
So it's the way it works right now is it's paid on a 365-day year. So you'll make a little bit more. It's a per diem. So like January, 31 days, right? So you get 31 days, February's 28, 29, one of those. Then you get that for that month, and then again 31 for March. So it's going to fluctuate a little bit different each month, but over the year, if you take it all out, it will be the 8,000. Now, if you reinvest it, now you're earning interest on interest, right? With who was it? Was it Einstein or Franklin? One of those two that says the eighth wonder of the world.
Yep. Yeah, right? I think it was Einstein. Compound interest.
Einstein. Yeah. So Einstein coined it the eighth wonder because of how powerful that is if you just keep reinvesting it. So you could either way, it's a distribution every single month with no lockup periods.
That's cool. So yeah, I mean, then on the second year, you're making money on 108,000, and then it just stacks from there. It's a slow burn, but it's good. Does it ever? Let me ask you this: are there thresholds where you bump that up? If people put in 250,000, 100,000, does that go to 12 to 15, or is it straight 8% all the way?
Yeah. I just chose in the business, on both sides, my borrowers and investors. I just don't play games. Like it's the same for everybody. We have investors at 10,000. We have investors at several million. So everyone gets treated the exact same. So the answer to your question about the taxes, it's a little different than what you guys are doing with the syndications because you're all a K1, right? So you have to file a tax return for the partnership and then distribute these K1s. And that's going to be in March. So we just did a 1099 like you'd get from your bank savings account. So it's a 1099 interest income. Got it. Nice and clean and simple.
Cool. So Kevin, as we wind down the show here, I'm curious about what are your future goals with your business and businesses, right? Like what are you looking to accomplish over the next, 1 to 5 years? Is there a vivid vision or something that you have drawn out that you want to get to?
Yeah, there is. And, my business coach helps me with this. So I would highly recommend if you guys don't work with, and I'm talking to the listeners, not you guys, the hosts, but if you aren't working with a coach of some kind, do that.
You're talking to us too, man. Don't worry about it. You're talking to us too. We need a coach. So
you guys, you were talking about your masterminds. That could fill the spot of a coach for sure. If there's accountability and there's some brainstorming and all of that, it's really the accountability piece, right? But so my coach, we do strategic sessions. Right now it's once a year. We might be switching that to 2 times a year where it's me and my leadership team. So all my C-suite, just 3 of us, right? But anybody that's with the C in front of their name or after the name, I guess, we all meet and we go with the strategy. We talk about what we're going to do. And they pushed me this time, guys. And I didn't think that we were going to do this, but I wanted to double income in 4 years. Sorry, double revenue in 4 years. Do the best we can to keep our ratios in line, but ratios go out of whack as you grow because you're hiring. So now our goal is 20 million, which is like doubling twice. So that's the goal now, nice. 20 million. And then we have the whole planned out for like who and when and how we need to hire and all that. So it's fun, man. Business is fun.
It sounds like the business coach is really helping you iron that out and put that in perspective and show you the roadmap. And we've talked to a number of people that have hired them recently. And like, it's one of those things for us that we've just been told so many times. It's like we're beating our head against the wall a little bit and we're just not, you got to prioritize what you want to do. And we just haven't done it yet. And it's something that for sure we will be doing just when we have the allocated appropriate funds for it.
The funds and the time, right?
Yeah.
It's a whole another echelon, but we're about there. So my question for you is, how did you find your coach? And you don't have to give me the price, but there's like a range here, right? Some people are $1,000 a month, some are 50 grand a year. So it's interesting. You're not quite sure how to allocate the dollars. The coach would be able to help you allocate the dollars and tell who's the right fit. So if you don't have a coach to get the coach, how do you find the coach?
That's hilarious. Yeah, I never thought of it like that, but yeah, that all makes sense. So I joined a group called the 12 Mavens. So all that is a leader peer group. So have you heard of like EO, for example? That's the biggest one in the world. Entrepreneurs organization. Look that up. But these are just like groups like what you're talking about, mastermind groups. And the 12 Mavens, there'd be a maximum of 12 people, and then we'd meet, and we'd meet for like an 8-hour meeting, an 8-hour day once a month. So it's just going through everybody's business issues, business problems. You had to come with a problem to the meeting, and then everybody worked together on your problem. So it was pretty amazing. And he was the one that was, I got invited to that, and then he was the one that was moderating it. And then COVID hit, and so the 12 Mavens just basically dissolved. I ended up joining EO, but I wanted to keep working with Jerry. That's his name. And so I hired him just on an individual basis. And now he coaches me and my COO. So we meet with him once a month now.
That's awesome. I really like that. And it's not, what I'm finding is, this is the last thing I'll say. I know we're winding down, but like the accountability piece is interesting when we get into the masterminds. There's an age range, and I don't think age totally has something to do with it. It helps for certain things, but some people's schedules are completely free. They don't have jobs, or they have no time at all. And like trying to find that happy medium of accountability. Like, do I really want like a 25-year-old? I hate to say 25-year-old, but like 25-year-old with zero experience checking in on me. It's just like a weird thing. I want,
well, that's the wrong group.
Totally. And it was just one example of it, but there's very niched down groups and central focused on a lane. And then there's others that have a wide range. And we've had to navigate that in our mastermind adventures here so far. So we're thinking we found the right one, but I don't know. Having a business coach that works specifically with you and drills down in your business is something that I think is the next step for us, because then there's no gray area. We don't have to worry about anyone else. The accountability piece is like, yo, you're meeting with this one guy or gal and they're cranking through everything. That's what I like. I don't really love the go into a little pod or a little group and have to share a little tidbit of everyone's story. You don't get I want the 8-hour, everyone on my business, tell me what I'm doing horrible and I'll fix it. And then vice versa. How can I help someone and go in for 8 hours and just give my feedback? And I think that's a lot better use of time. So valuable. I don't know. I think that some of these are structured not appropriately, and I think that you have found the right niche, or not niche, but right vehicle for yourself.
Look up EO. Just write that down. EO, and you have a threshold to even be approved. I have to prove that we make $1 million a year to be involved. So that's weeding out that 25-year-old that doesn't have any experience. Right. Everyone in there knows what they're doing.
Very cool. Thank you.
So, one of the last questions of the show is, going back to your 18-year-old self, Kevin, let's say you had a chance to talk to him, look at him in the mirror. What advice would you give him, pending he would listen, and why?
Oh, man. That's a really tough question. I've been asked that many times in different ways. So I know the answer, but I got to tell you, I feel like I had a lot of fun at 18, so I don't know that I would want to do anything different. But here's the mistake I made. There's a lot of ego in any business, but real estate has it too, like the biggest fish, right? And so we talk about how many doors we own and how many doors we control. And you guys will probably hear it all the time in the syndication business. And what does that mean? Like, you tell me that you have 1,000 doors. That's fantastic. Are you making any money? Like, that's what actually matters here. So, and I only say that to preface my story here, but when I was buying that 1 or 2 house every single month, that was my goal. I wanted to buy a house a month. And high achievers like us, we do whatever we have to do to hit that goal, right? We set a goal and we're like, we're going to freaking hit that goal. And we just plow through walls to hit it, right? That's why we're successful. Well, my goal is 1 a month, so I'm going to do whatever I can to hit that 1 a month goal. Well, what ends up happening is that goal is so non-beneficial or non-supportive of what I was actually trying to accomplish, because now I started doing deals that don't make any sense just so I could hit that goal, right? And it all comes down to how people viewed me in the local real estate investment associations and on those online forums. Like, I was like this little freaking celebrity, this 23, 24-year-old kid just making all this money, and I was feeding into that. So going back, I would say let's be smart about the words we use to ourselves, and let's be smart about the goals that we're setting for ourselves. And does it really benefit what we're trying to accomplish?
I think that's awesome that you said that way, and especially how you preface it like you're having a lot of fun. You don't know how much you would change. I think that's candid and really cool too. But also to go off what you just said, it can't just be about the money. It because it's like there's so many ways to make money, and you can do it off the backs of in ways that you maybe are unethical. Like there's plenty of ways to go out there and make money. It's like, what are you going to do with that money that you've made if you're not doing it the right way, or you're not, having fun doing it, or it's just like starting a business just to start a business that you're like, oh, I'm printing money, if that's even possible, but you're not enjoying your life, or you're not fulfilling that, like you said, like what's the goal even for? And I think that once you have all this money, if it's just sitting there or you're miserable, like there's no real point to it. So I love that you said that you were, your ego set in. It's like, were you even really happy doing what you're doing, or were you even really on the right path? And I think that we've come across that several times where it's like, not that we're not doing it ethically, because we always feel like we are, but it's like, you want to make sure that every single day when you get up that you can lay your head on the pillow at night, but also that you're on this path to like, look, we're doing this podcast. We're doing it because we like to do it. So I think that's a really important piece of the entrepreneurial journey as well.
Yeah. We could do a whole episode on that. Like, what's your why, and why are you even here? Right.
Yeah, it's interesting. I do appreciate you mentioning the door count though, because we've seen that a lot in the industry. You see everybody's link or on their Instagram bio, they're like 15 million AUM, assets under management, or like 455 doors, and you're like, and it's the sexy flash thing. But are you making money? How did you get there? Are you just an LP in deals? Like, are you just strictly like a tiny sliver of those? So.
Which is fine, but don't advertise it like as if you own 100% of that asset, right?
100%. Yeah. 100%. I'm just saying, like, for us, when we were first coming up, we, in going through this, we're like, damn, we have like 5 doors. How the hell does this person have 450? Like, we'll never get there. And then you realize you have the conversations. Oh, they've jumped in with other people and they've partnered up, and so there's a little bit of a facade for some people, but, I think it's important to check the ego in the beginning. Right. And, there's a lot of people that get big heads, but as we're kind of navigating this life and this real estate investing journey, we found a lot of people are going through the same thing. And like entrepreneurs are we're all just fighting the same fight and just trying to provide for our families, everyone wants the time, location, and financial freedom, right? Just, you want to be able to do what you want when you want. It's a hard thing to navigate because you realize there are some sharks out there and people that are not looking out for your best interest. And that's what sucks. But that's the 1%. We found 99% of people, or at least the high 90s that we've talked to, are just in the same boat. We're having these amazing conversations, and it's so cool to learn about their stories and trials and tribulations that they've overcome. So that's the point of our podcast, is to showcase their stories. And it's just cool to learn about, what you've been doing. You have a lot of different avenues for people to invest in. So people, you should definitely check out Kevin. This is a great episode. I just wanted to put that in there. Like, there's a lot. Be careful of who you talk to, but there's a lot of good people out there, and you just really have to find them and keep your circle close. That's what I'd recommend.
Love it.
Cool. Well, Kevin, this has been awesome. Thanks so much for coming on. I'm curious. People are probably, after listening to how in depth you went on the multifamily and the single family and the lending, and obviously you've been doing this for a long time. I'm sure they're interested to hear more about you. Maybe after this episode, they want to learn more about your story, connect with you, network. What's the best way for people to do that if they are interested?
Yeah, it's interesting you say bring up the market, and we talked about this briefly, but I get questions all the time like, is this another 2008? Are we gonna is the sky falling? Like, what am I gonna lose everything? So I get that question a lot, and it doesn't resemble 2008 at all. I know that's the most recent recession that hit real estate, so it's like fresh for us. We were all alive, we knew what was going on. But it doesn't resemble that. We're not going to see the same thing. What we might see is what happened in the early 90s, like mid 1990s. Early 1990s, like mid 1990, that year. And that's when the housing fell about 14%. In fact, we've already seen that here.
Depending upon the market, yeah.
Yeah, exactly. But that was after the savings and loan crisis, which banks started failing, right? And then we had high inflation and really high interest rates. Those are the interest rates that we hear about, like in stories, like 18% mortgage rates, right? So are we there? No, but it does resemble that. So it was Mark Twain that said, history doesn't repeat itself, but it rhymes. I'm just trying to figure out like what might be coming down. So I studied that recession and where we're at today. And I wrote a report that goes into a lot of detail about what we went through then. So we could try to figure out what might be coming down the road now. And so I give that away to your listeners for free, if that's all right.
Yeah, let's do it.
Yeah.
Cool. So thepinereport.com, and that's a good way to reach me too. So thepinereport.com, you could download that report for free. Otherwise, it's just pinefinancialgroup.com.
Perfect. Cool. Kevin, it was a pleasure having you on the show. Thanks so much for dropping some bombs and some wisdom on us. We look forward to staying in touch, man. This was excellent.
Thanks for tuning in this week to the Weekly Juice Podcast. If you liked what you heard, please leave us a 5-star review on Apple Podcasts, subscribe, and share with friends. The more ratings we get, the more ears we'll get on our show, and in turn, we'll be able to provide you with more high-quality guests. You can also find us on Instagram at Weekly Juice Pod, where we post daily tips and tricks and document our own journey towards financial freedom. Make sure to tune in every Wednesday to get your weekly juice.